Thank you very much for joining us once again. Welcome back. This is our fourth lecture on financial management. In this lecture, we will discuss financial intermediary and capital and money markets. In our previous lectures, we have already discussed what is financial management and what are the objectives of financial management. We have discussed what is wealth maximization, how to maximize the wealth and how to measure the performance. In our third lecture, we have already discussed economic environment of the business. Today we will discuss financial intermediaries and related money markets and capital markets. So let's start it. Financial intermediaries act as a middleman. These are the institutions that links the parties which have a surplus funds to the parties which has a fund deficit. One party has surplus funds, other party has deficit. So the party which has a surplus funds, that party will be looking for some sort of investment, and the party which has deficit fund, that party will be looking for some sort of borrowings. And intermediaries act as a middleman. They connect two parties. In other words, we can say they can bring together the lenders and the borrower. So what are the different examples of these parties? These are the parties. This function can be done by the commercial banks, finance houses, building societies, government, national saving department. These are the different parties which are usually acting as a middleman. And what are the benefits of this? The major benefit of this is borrower will be able to get access to the funds very easily, and the lender will be able to lend its extra funds very easily. So these are the two major benefits. And the third major benefit is risk for the individual lender is reduced by pooling in case of syndicated loans. So these are the three major benefits. Let's take, this is a bank. This bank is acting as a middleman. So this is the lender. This lender A has surplus funds. Borrower is a party B. Borrower is in need of the money. Borrower will approach the bank for money. Lender B has already given the money to the bank in the form of deposits. So what the bank will do? So bank has taken the deposits as 3% and bank has given the loan at 5%. Bank will make a commission. This is income of the bank. These intermediaries might be there in the local market or might be they are in the international markets. So usually in the international markets where the large amount of financing is required, companies are approaching the international market. Otherwise, usually companies are taking the financing from the local markets. If the companies are looking for borrowing, this borrowing might be from the money market, or this borrowing can be from the capital markets also. So if this borrowing is for a period of less than 1 year, the borrower will approach the money market. And if this borrowing is required more than 1 year, which is called medium term or long term, then the borrower will approach the capital markets. The different example of the capital markets are banks, building societies, insurance companies, stock exchanges, venture capital organization. So we can say this borrowing or financing, it can be in the money market or it can be in the capital market. If you are looking for short-term borrowing, you will go into the money market. This will be covered for a period of less than 1 year. If you are looking for a medium term or long term borrowing, which covers period of 2 to 5 years for medium term and greater than 5 years for long term, in both of the situations borrower will approach the capital markets. In the capital market, these are the parties who will be already available there, and they will act as a middleman and they will give financing, they will give money to the borrower. So now the question arises, what is the major factor that affects this borrowing? So of course, this is the interest rate. So borrowing rate will have a huge impact on the borrowing. So whenever the interest rate will come down, so we can say this is the interest rate. This interest rate will have an impact on the borrowing. If this interest rate will come down, it means borrowing will go up. On the same way, if interest rate will go up, borrowing will come down. So we can say this interest rate and borrowings are inversely proportional. Higher will be the interest rate, lower will be the borrowing, and lower will be the interest rate, higher will be the borrowing. This is from the point of view of the borrower. On the other hand, if the lender is getting higher rates, so it will be more deposits in the bank. If lender is getting lower rates, it will be lesser deposits in the banks or financial intermediaries. We can say deposits are directly proportional with the interest rate. In the same way, we can say borrowing will be inversely proportional with the interest rate. This interest rate itself depends upon the size of the assets, influence duration of the loan as well as size of the loan as well. The rate of interest paid on government borrowings, this is called benchmark for other interest rates. So there is a trade-off in between risk and return. We all know that higher will be the risk, higher will be the return, lower will be the risk, lower will be the return. So we can say risk and return are directly proportional. Investor has a choice to make an investment in the debt security, or investor has a choice to make an investment in the equity. If the investor is making investment in the debt securities, investor will get a return in the form of interest income. This depends upon the financial risk, because debt securities are carrying only financial risk. So investor will expect return only against the financial risk. So it will be considered interest income for the investor. At the same time, if the investor is making investment in the equity securities, so investor has a risk of financial risk as well as business risk. So here investor has two risks. If the investor is making investment in the equity security, investor has two risks: financial risk plus business risk. If the investor is making investment in the debt security, investor has one risk. Here investor has two risks. We have just discussed higher will be the risk, higher will be the return, lower will be the risk, lower will be the return. So we can say the return on equity investment will always be greater than return on debt investment. Usually these are the four different forms of investment. Investment in the government bonds, company bonds, preference shares and ordinary shares. Government bond. In the government bond, there is no business risk, no financial risk, because there is no almost minimal chances of default, because government is standing back of these securities. So risk is almost zero. So return will be accordingly based upon the risk is directly proportional to the return principle. On the other hand, these are the equity shares. Equity shares, these will have equity share, there is the risk of financial risk as well as business risk. We are assuming company is a geared company, company has financing as well. So here is a higher risk. So here the return that will be, this return portion will be higher as compared to this return portion, because here risk zero, lower return, here risk high, maximum return. So company bonds, it will also be considered some financial risk will be there. There are minimum chances of default. So this is the next to the government bond. So government, if assuming government bond interest rate is 5%, so company bonds might be, it will be 6%. In the same way, preference shares are a bit more risky as compared to government bonds and company bonds. So return will be higher as well, might be 7%. And these are the ordinary shares. This is the most risky investment out of these all four. So might be the return is around 9% or 10%. We are just classifying into hierarchy, where the risk is minimum, return will be minimum, where the risk is maximum, return will be maximum as well. So this is reverse yield gap. This is very interesting topic. We have just discussed higher will be the risk, higher will be the return. And we have just discussed equity is a more risky investment as compared to investment into the debt securities. And the reason is because equity is carrying two types of risks and debt securities are carrying one type of risk. But in certain situations, yield on shares, yield on equity is lower than the yield on debt. This is called reverse yield gap. What is the reason for this? They said this can occur because the shareholder may be willing to accept lower return on their investment in the short term in anticipation that they will make capital gains in the futures. So based upon the expected capital gains, they are accepting the lower return now. This process is called reverse yield gap. As we discussed, investment in equity or investment in debt securities, these are the alternatives for the investors. And this is for sure, interest rate fluctuations will have an impact on the value of the share as well. So higher will be the interest rate, higher will be the expected rate of return of the shareholders, and lower will be the market value. On the other hand, lower will be the interest rate, lower will be the expected rate of return from the equity, and higher will be the market value. So how this works? This is the current situation. We can see in this current situation, dividend is 10, expected rate of return is 10 as well. So what will be the market value of equity? Market value of equity is equal to D naught over KE. We will discuss this. D naught is the dividend. KE is cost of equity, which is equal to D naught over KE. D naught is 100. K cost of equity is 10%. So 100 will be the market value of the share. Now fall in interest rate, fall in expected rate of return, increase in the market value. We have seen dividend is constant. When interest rate has fallen, expected return has fallen is to 8%, assuming 8%. So market value, it has gone up. In the same way, if interest rate has increased, expected return will also increase, market value will come down. This is the example. So based upon this example, we can prove that higher will be the interest rate, higher will be the expected return of the shareholders, lower will be the market value. In the other way, we can say lower will be the interest rate, lower will be the expected return of the shareholder, higher will be the market value of the equity. So we can say interest rate will have inverse relationship. We can establish this, that interest rate will have inverse relationship with the market value of the equity or market value of the share. In the same way, we can say interest rate will have a direct relationship. So interest rate will have a direct relationship with the expected return. So what is the reason of inverse relationship of interest rate with the market value? So interest rate will go up, borrowing will come down, demand of the security will come down. Lower demand means supply is constant, demand has come down. When demand has come down, it will lead to decrease in prices. So increase in interest rate has led to decrease in the market value of the security. On the other hand, if interest rate is coming down, borrowing will go up, purchasing power will go up, demand of the securities will go up. This demand means supply is constant, demand has gone up, so it will ultimately, what will happen? Supply is constant, demand has gone up, so market value of the security will go up. Thank you very much for joining us. So in our next lecture, we will discuss working capital. Thank you. Bye-bye.